So Tom Ferry, thank you for joining me. So
Thanks for having me.
yeah, so I'm Lisa Doyle with J. Rockcliffe Realtors here in Northern California, and we've had so many questions about just real estate in general, Tom, you know, the market conditions, what's going on. So I'm so glad that you joined me, and I wanted to introduce you quick. I have a little bit to share about your awesomeness. So Tom, of course, I think the first time I ever saw you in person live was like in 1989, right? So that was a long time ago. But Tom Ferry is a New York Times bestselling author. You've owned businesses, you've coached businesses all over the world, Tom, real estate companies, business owners. And I think, you know, one of the things that I'm most impressed about you is all of your success and all the companies you've helped, you've contributed to, and you've owned and built, is you're just an overall really good human being. And I think that that's something people need to know. You know, I so appreciate all the contribution that you've done for me over all these years. So
Thank you, Lisa. I appreciate it.
yeah.
It's crazy. I was talking with my 21-year-old son. He's like, how long have you been doing this? I'm like, 30 years. And he's like,
Yeah.
30 years? Looked at me like I was old. I was like, no. I said, maybe I need to start saying 20 years, right? So people don't think I'm getting old and outdated.
Yeah, no, but you've, like I said, you've contributed to the real estate world, and, you know, you coach real estate brokers, but you coach business leaders in all walks of life. So, you know, really being in tune with real estate. And, you know, that's what we want to talk about today is, you know, housing, a little bit about the economy and how housing is impacted and how housing might actually contribute to, you know, our overall country's recovery. So, you know, I know you and I have some good things to share. But what do you see right now looking at our industry? And I know we have some slides that we want to share. You know, a lot of people have concern in the marketplace, a little bit concerned about economics, even though real estate's been very active. You know, we are in a very heated real estate market, which is surprisingly heated. I think most of us after COVID, you know, we were shut down for 2 months. We were unsure what was going to happen. And once we opened, it's like the floodgates open and buyers from all over, you know, flocking into our market. How do you see things moving forward?
Well, I think it's important first and foremost to start with the overall economy and really the jobs market. Last Friday, the Bureau of Labor came out with their most recent stats. I think what's on the minds of a lot of people is, you know, if the economy's bad, if people aren't working, you know, the assumption is that home ownership is going to go down and home prices are going to go down. And Lisa, I'll forward you the slide from our This Week in Housing show. I wasn't thinking about it as I was preparing for this today. I apologize. We did a little analysis of the last 5 recessions and how that and unemployment did it positively or negatively impact housing prices and the number of transactions. And I know when we displayed this now almost 3 weeks ago on This Week in Housing, we had a lot of people scratching their head. People were assuming that if unemployment is high, that if we're in a quote unquote recession, that of course home sales have to drop. And actually the correlation was the opposite.
Yeah.
So again, we're going back over 5 recessions. So I apologize for not having that slide for the people that are watching. I'll get you that slide, Lisa, and then you can post it on your Facebook page.
Yeah.
But that even includes the real tragedy, I would call, of 2007, 8, 9, 10.
Yeah.
So even then, we saw transactions going up as prices dropped. Home ownership was still skyrocketing in the middle of all of that.
Well, and I think one of the things, the biggest difference is, because we have had a lot of questions about that, is when is 2008 going to be back, is what people keep thinking. And I think the biggest data that I've noticed that's different about our country back then, because you and I, we've both been through so many different cycles, right, in all these years, is the average consumer mortgage debt was what, like $865 billion back in the day, in like 2006, 7, and 8. And right now, I think the consumer debt on housing is like 1/3 of that. So people have more equity in their homes. And so if they run into trouble, they have more opportunity. And I know we're going to show a few slides about that. People can sell their homes, and they're, you know.
It's an interesting, I mean, first of all, if you got one person that's in a position to lose their house, in my opinion, that's a horrible thing.
Yeah.
When you actually look at, for example, the forbearance numbers, that's the number of people that are essentially pushing off their mortgage through their bank for 3 months. And by the way, you know, now with legislation, people that are in that situation can now push it out 360 days. So let's call that just 5 days short of 1 year. Now they still owe the money.
Right.
But they'll make it up on the back end. The interesting data point is 92% of all homes in the country have more than 10% equity.
Yeah.
92%. And you've seen the slides that we've shared in the past, where today 42.1%. This is an interesting fact for many people out there. 42.1% of all homes in the country have no mortgage.
Yeah.
So
Awesome.
you might have a situation where somebody has a very tiny mortgage on their house and they took advantage of the forbearance, right? They were uncertain, they were fearful, and they could just hit that button on their bank and say, I want to push off my payments.
Right.
When people say to me, oh, are we going back to 2008? Are we going back to 2009? Are we going to go back to this bank-owned foreclosure REO market? The answer is no.
Yeah.
The answer is no, because you got 92% of the people have at least 10% or greater equity inside their property. And we're going to talk about today, home values are appreciating across the country right now.
Yeah.
Right? So that 10 could be 10.5, could be 11 by the end of the year. When you're seeing that, who in their right mind is going to go foreclose when they could just put it on the market and sell it in a traditional manner?
Exactly.
So we're very bullish, right, on how housing is once again leading the economy, just like it did last year when we went into a little micro recession, right, over the summer. Housing is what brought us out of it. Yep. And now with interest rates as low as 2.8% or 2.88 on a 30-year fixed, which, by the way, Lisa, that's the 8th time this year we've hit a record low on interest rates.
I know, we just locked a family in at 2.6. I've been in the business 34 years. And of course we track it back 60 years, as long as they've been tracking. And there's never, ever, ever been a time that this is, that's why. Yeah.
8 times this year, 8 times this year. So what I'm saying to people that are hesitant, I was literally talking to a family member recently, and he's like, okay, my situation. I got 2 young kids. We're going to be homeschooling this year. My wife and I are in the house. We work. Like, it's a stressful family situation. He said, I got the opportunity. We've saved our money. We're in a good position with our equity. Should we move up and buy the house? I said, listen to me. So John Wesley, who on my team, right?
Very well.
Family and friend, said, listen to me. Whatever you can buy today, if you can buy the right house that gives you the dream home amenities that so many people are craving for today. You're seeing it, people coming from the city to looking to get a backyard, looking to get a pool, looking to get more of a lifestyle, if you will.
A suburban feel. Yeah. The suburban. Yeah.
I said to him, listen, whatever you buy today, buy in a comfortable, don't put yourself in financial, hard way. Buy as much as you can and recognize this. You will brag about your interest rate for the next 20 years.
Yeah.
People they're not just going to brag about, hey, I bought a house, in is it Black Rock or I was thinking
Black Hawk, yeah.
Right? The great golf course community, et cetera. They're going to always brag about appreciation, but now we're going to talk about my interest rate's at 2.65. Right? That's what people are going to be bragging around for the next couple of decades.
It's crazy. Even a year ago, like you mentioned, that the market went through a little bit of a freeze last year. Interest rates went up to almost 5% so quickly. And then we came down again and the market heated up again. But interest rates can change on a heartbeat. I mean, anything can happen over this next couple of months to change rates back up to where what you might say normal, yes. 5 or 6% would be considered normal. So I'm with you.
As long as you and I have been doing this, 5 or 6%. I mean, when you're talking to a millennial buyer or you're talking to a savvy, buyer or seller today, they want to hear 5 or 6%. But, when I reflect back on buying my first house in 1989 at 11% interest rate, and it dropped into the single digits, I was so excited to refinance. So it's perspective, right? Yeah. Right now, we're very in this bubble of concerned about the economy, concerned about unemployment, concerned about home ownership and what's happening. Which I think, Lisa, for the sake of time, we should talk a little bit about what the Bureau of Labor Statistics just put out.
Definitely.
So, Kelsey, throw up the slide for us, if you would. There's a lot of encouragement. It's now, if all of you that are paying attention, last Friday, they came out with the stats. My friends over at Keeping Current Matters, who I co-host this show, This Week in Housing, we take all this real-time data and we put it together primarily for our real estate clients to then go share with their past clients, their sphere, their friends, so people can make a more informed decision than just call it headline reading. Yep. So what I want to point out here, and you can see that highest point, we gained 1.8 million jobs. Now remember, for context, we had 51 million people file for unemployment. But today that number is sitting, and I don't want to misquote it here. We're looking at like about 10.2%, right? Total
Yeah.
unemployment. So, call that, 14 and a half, 15 million jobs, which is a lot of people.
Yeah.
But I want to be clear, the positive signs of the jobs coming back are just that, right? Everyone talked about the V recovery versus maybe the W recovery versus the Nike swoosh recovery. Every economist is saying we're absolutely in that spiking V, recovery, a horrible second quarter, and a fantastic, unbelievable third quarter, which is what we're seeing now. My point to you here is take a look at that biggest number, Lisa, 592,000 jobs in leisure and hospitality.
Yeah.
So, in California, there was a horrific statistic that I saw that we led the nation in the most small business restaurants that closed forever.
Yeah.
During COVID, right? And again, I'm a lover of small business.
Which is heartbreaking for sure.
It's absolutely heartbreaking. So to see that number, not only that hotels are coming back, restaurants are coming back,
Yep.
it's very, very encouraging. Matter of fact, let's show the next slide, Kelsey. This gives you a little context for everyone watching. You got to pay attention to the data. You got to pay attention to the trends. You see right now, January 3.6, February 3.5% overall unemployment.
Yeah.
March creeped up to 4.4, but if you were paying attention, that only happened after March 15th.
Right, after we shut down. Yeah.
Right? After we shut down and we were all, in a state of, dare I say, panic.
Yeah.
And in April, we saw a massive spike. And ever since then, that number's been creeping down the right direction.
Yep.
So there's a lot of economists that are saying that by the end of 2021, we could be back to between 4 and 6% unemployment. Now, I want to be very clear. If you're watching this right now and a loved one was furloughed, a friend of yours, your adult child lost their job, make no bones. I'm not saying these numbers are good. I'm just saying the data is going in the right direction, right?
Well, for sure.
We're going in the right direction.
And you would think, after all we've been through as a country and the world, that really, as much as like you said, it's a tragedy if any business goes out of business or anyone loses their job and has, their life put up on hold for a period of time. But 10.2 really in the big scheme of things is progress. We're making progress. We're like you said, we're heading in the right direction. People are getting back to work and business is opening.
100%. So Kelsey, show the next slide. I think this will really drive it home. So one of the things that we pay attention to is temporary unemployment versus permanent unemployment. You can see that here on the slides.
Yep.
The one showing that, that permanent number on the graph to the right. So you look at this and say, well, look, April, May, June, July, we've got 2.9 million people that are permanently unemployed. Now, working with a few CEOs of publicly traded companies, when all of this hit, they took a lot of their early retirement opportunities with people who've been with the company forever and said, hey, we'd rather pay you your options now, give you some stock now, rather than furloughing them and then having their retirement occur at the end of the year. So you look at these numbers, and again, if it's one person that we know and we love that desperately wants to get a job, wants to be back in the workforce, these numbers are still tough, right? Anyway, add it up. But again, if you look at the data, right, we're going in the right direction. That's the key. We got to help the 9.2, right, back to work. That's really what this next election cycle is going to be about. It's going to be what the fourth quarter is going to be about, and all of 2021 going forward.
Yeah. Well, it's just people need to have some hope that, and it's such an interesting thing. Half the people that we talk to are so optimistic. They're hopeful. They feel like even if they're not employed, they feel positive about it. And then I've talked to half the people who feel where you sense a lot of hopelessness. And so this hopefully gives people hope that this is really not long-term. This is, like you said, this is a V-shaped recovery. This is a bounce back to what we had before. And it's not going to take that long.
Yeah. And the data will prove this out, Lisa, but I do want to draw a point, especially because I'm in Southern California. I'm assuming the vast majority of the people that are watching are in California.
Yep.
In July, right around the 4th of July, when our governor said, oh my goodness, we got to close everything down again. And, tragically, my city, Newport Beach, they're the problem, right? They're out on the beach. And but if you go back and look at the data, guess what? Yes. Did we all wear a mask? Because that's the right move to do, and we should all do that, right? Did we all pay attention? Yes, right? Did some places shut down temporarily? Yes. But when you look at what happened during housing at that exact time, the number of showings that were happening safely, well, we're going to show you the data in a minute,
Yeah.
right? It's actually one of the single spikes coming out of that, because once again, people said, am I living in my dream home now? Am I living in the right house right now? That really became a major one of our pieces of research we're doing, Lisa, is just around what's important to people today when it comes to home,
Yeah.
and why are they moving? And we were talking about it before we started the show. There's a lot of people today that are working in San Francisco, working in Los Angeles, working in San Diego, and they're suddenly in a work from home situation.
Yep.
And they do that way for a year to potentially a year and a half. And they're all saying, if this is my situation, why am I going to live in this 2-bedroom condo? I'm going to go live in Palm Desert. I'm going to go live, I'm going to go live in Lake Tahoe. People are making those types of choices today.
Yep.
Even though it might seem short term, again, what's the value of a home today?
Well, and it's interesting. So our area, so we're, Northern California, as you know, and our market has always been driven by the tech, the tech companies for the last 10 years. We're very driven by Google, Facebook, all the tech companies, Zoom, and all the companies that are thriving. So people come here and they commute, right? They've always done that. But now the companies are telling them, even post-COVID, you're going to be able to work from home a lot more than you did before. So people they're flocking here because they can buy a nice home in the suburbs with good schools and pay less. So our market's just been, like you said, unexpectedly heated, really.
Yeah.
Yeah.
So let's talk about the housing market. So Kelsey, go ahead and move 2 slides forward, if you would, please. For my friends out there that are watching, we like to pay attention to what are the leading indicators, what's the cause, not just the effect. Yes, homes are selling, and yes, they're selling quickly, and yes, they're selling with multiple offers. But the very first leading indicator is what's happening from the number of buyers that are going out and looking at homes.
Yep.
Whether that's being done virtually, which we're seeing today, or physically people walking into houses with masks and being, 6 feet apart and socially mindful. You can see that in the beginning of this year, we had an early rush into what is traditionally the spring market, which is, middle of March through, call it June, July, before we get into the summer months where traditionally things would slow down, summertime, kids out of school. Well, obviously when COVID hit, we dropped to historic lows, 85% down in terms of home buyers out looking for property. So when you see, right, as we released, around, May 5th, May 6th, that week, we went from literally negative showings to buyer demand off the charts.
Yep.
And minus that 1 week that I mentioned earlier in California, right, 7/7,
yep,
that week where we dropped off, you can see the buyer, basically, I want to say this to you all the right way, that the interest rates and the desire for the right home trumped the fear of COVID.
Yeah.
The best way to describe it. And that is not in any way, shape, or form political. That is just look at the data, right? Just look at the data. And by the way, everyone watching, you can go to showingtime.com and actually, or just Google showing time COVID, and you'll see everything that we're seeing compared to last year, the number of showings. And without a shadow of a doubt, we are off to the races this year. And even though we had a slight decline, you could see going into the first week of August, looking at the numbers today, we're already going right back this direction.
Yep.
Let's take at the next slide. So the next one's a really good leading indicator of what's going on. And that is people that are looking to buy a home that fill out a mortgage application with their bank or with a loan officer. Once again, you can see we had a very strong start to the year. We dropped off dramatically. Now remember, this does not include refinances.
Right.
Right? In the refinance market, it would look like this: green, 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 and it still hasn't stopped. And I'm telling you, for everyone that has no interest in moving, refinance your house again. Right? With the rates dropping to 2.88 on a 30-year fixed, a home buyer today has picked up $31,000 in additional purchasing power.
Yeah.
Think about that for you as a homeowner. Even if you did it on a 10-year note or a 15-year note and really went for a lower interest rate, the money you could save today, not to go out and spend like crazy, I don't recommend it,
right,
to invest, to put your kids into college, right? to pay down any debts you have. Don't
Yeah,
go out.
pay off your house, work at paying off your house faster, Yeah.
I mean, you and I have talked about this for decades, right?
Yeah.
Make 2 or 3 extra payments with the difference. I got Tristan, who's one of my videographers. He and his newlywed wife bought their first home, and they had an interest rate in the 4s.
Yeah.
They just refinanced into the high 2s. The difference in money for them, Lisa, they said, oh, we've got, $400 or $500 extra a month. They said, no, you don't. Pay off your mortgage.
Yeah.
They're going to be really happy when they do that. So again, for everyone watching, you can see we've had 12 straight weeks of year-over-year increases in people walking into their bank and saying, I'd like to buy a house. I need to fill out an application to see what I qualify for. So these are 2 really strong signs. It doesn't solve the problem, Lisa, but we'll get to that at the end. Before we go to this next slide, working on this show This Week in Housing, dealing with all these economists, the Ivy Zellmans of the world, the economists at Realtor.com, at the National Association of Realtors, talking to people at Merrill Lynch, Bank of America, Wells Fargo. To say that most of them are pretty dry and analytical would be an understatement.
Right, for sure.
The team got together and did something kind of fun, because what's coming out of their mouths today is so bullish. It's so exciting that, well, just take a look at this next slide. Kelsey, go ahead and move forward one. It kind of looks like a movie, right? Like Ivy Zellman, who is, basically Wall Street turns to Ivy and says, tell us what's going on with housing, right? She's that important to all of Wall Street in terms of understanding the data, picking apart the nuances of housing. She said it's shockingly strong, right? You see an astounding rebound from Realtor.com. Myers Research has been nothing short of remarkable. What they're referring to is the slowdown and then the massive acceleration of home buying that's been taking place really since, as you saw it, right around that first week of May. So let's go a little deeper with something Ivy said. So go to the next slide, Kelsey. You can see here, Ivy says, whether in terms of pending contract activity or our proprietary buyer demand ratings, the various measures of demand captured in this month's survey can only be described as shockingly strong in spite of the resurgence of the COVID-19 cases. Now, again, as I mentioned, if you are a Wall Street enthusiast, if you're an investor in things like REITs, hotels, shopping centers, land, if you own stocks in publicly traded home building companies, Ivy is their go-to. Mm-hmm. So when Ivy starts saying things like shockingly strong, people pay attention.
Yeah.
Let's go to the next one, Lisa, and then I want to get your thought on Quicken Loans, by the way. So Quicken Loans came out and said the pandemic has not stopped the consistent home price growth. Because I know you want to talk about that, because there's a lot of concern right now about, are we in a bubble again? Is this 2004-5 as an example? So again, Quicken Loans came out and said the pandemic has not stopped the consistent home price growth that we've witnessed in recent years. By the way, did you see Quicken went public last week?
I saw that. That's so interesting. Quicken's been a resource for some of our clients. We tend to work with local mortgage brokers more than we do typically. Yeah. But Quicken definitely has been a resource for a lot of people. So I think that I have a long time past client that used to work for Quicken. So I got familiar with them early on, so yeah.
Again, when you see an IPO like that come to the market, and even though it probably didn't come out as high as anybody would like, starting with Dan Gilbert, it's still just a positive sign, right? Yeah. The opportunities that we're seeing right now, right? Some of the most conservative people are saying, go all in on real estate. That's a sign.
Well, and I remember Steve Harney, from Keeping Current Matters, I've tuned into him for years because of your recommendation. And I know you are very, in touch with him constantly since the whole beginning of COVID, is he said it early on that he believed that housing would be the, really the shot that would cause the economy to get back on track. And it feels like that's probably the case is, there's so much revolved around the economy of real estate. There's so many people and, aspects of real estate that that's, push the economy.
Well, there's two interesting numbers. First, when someone buys a new home, it has an $81,000 impact on the economy. So that's a construction property. When they buy a resale property, something that, Lisa, you might list for sale that is, 10 or 15, 20, 30 years old, it's about $51,000 brought into the economy. And if you look at the overall GDP of the US, the current stat's about 17% is tied to real estate.
Yeah.
So it's a very important part of our overall economy. And at the end of the day, housing is never going to be out of style. We're always going to need a place to live, right? That's
Exactly.
mindset.
Well, and I think one of the biggest questions that we get a lot, and I think every area is different. I think there are some markets that are more, you know, related to tourism, you know, travel, Las Vegas, places where they're going to, maybe they'll see a longer recovery time. But we're so fueled. I have a lot of clients who say, is this sustainable? Is 2021 going to be real estate strong? And I would say we don't have a crystal ball, but because our market is so fueled by the companies that are thriving, you know, the tech companies really push the Bay Area, at least. It feels like our demand is going to remain robust, you know. That's what we're seeing.
I agree. And what I would say to everybody out there, if you were going to buy a house in the next 12 to 18 months, what I would say to you is there is no doubt in my mind during the next 10 years, you will see prices go down.
Yeah,
right?
there's always a cycle. Mm-hmm.
We're on basically an 11-year, you know, call it, you know, bull market where home prices just continue to, bear market, excuse me, just continue to appreciate. Coming out of the 2007, 8, 9,
Yeah.
it was really a real estate recession, right? It was all about a housing recession. So let's actually take a look at the next slide, because this will give you some insight. And I'm going to close out my thought with people if they're buying over the next, you know, 18 months, what they should be thinking about. So I bring this up because just a month ago, we looked and said, okay, what's the MBA saying? What's NAR saying? What's Ivy Zelman saying in terms of, you know, what's going to happen with home prices in the future over the next 12 months? And the thing that stood out was that CoreLogic came out and said 6.6% down. That Zillow, who, we both know, I mean, I know the chairman and CEO, they're out buying houses again.
Yeah.
They were saying home prices are going to go down on average across the country, down 0.7%, so less than 1%.
And this was a month ago. This was a month ago, right?
Just 30 days ago.
Yeah.
Fannie and Freddie, right? Obviously, Routers, Polls, Zelman, everybody else was in the green, but even Fannie saying, less than 0.5% home price appreciation. Now that was 30 days ago. Let's take a look at what they're saying now. So Kelsey, go forward again. So here we are 30 days later. Look what people are saying now. Fannie, right? Fannie is saying 4.4% appreciation, right? Freddie Mac saying 2.3% appreciation. Zillow hasn't given us an exact, but you can see they're saying, hey, it's going to be somewhere north of 1%. CoreLogic went from down 6.6 to just down 1%. Now, again, Lisa, no one has a crystal ball.
Yeah.
Right? I just bought a new home, and making that decision to buy that house, I said to my lovely wife, we're going to brag about our interest rate forever, right? Because of our relationship with our bank, we were able to get a 2.25 30-year fixed.
Crazy.
Right? So that money, it's free money. Now, will home prices go up and down? The answer is 1,000% yes. They always do. They always will.
Yeah.
Question more so, I think the bigger questions that are on the minds of people in California right now, and I hope they're all paying attention, and for you as a trusted advisor in your local marketplace, you should bring on someone to talk about Prop 13.
Yeah, for sure.
Right? Because as a California resident, right, that scares me, right? If they say they want to increase or eliminate Prop 13, and all of a sudden now we're sitting at 3% property tax or 4% property tax. Dallas, Texas is one of the highest in the country at like 2.5, and they proposed 8% property tax.
Wow. Yeah. Prop 13 is definitely a conversation we're going to continue to have before we get to vote in November. It's even to protect the elderly who lived in their homes since the 60s, we have to protect.
Yes, that was the whole reason they were taking grandma and kicking her out of the house because she couldn't afford to pay her taxes.
Yeah, we have to protect the elderly. It's like on our tax rate's 1.25%, which we have a very high price range in the Bay Area. But compared to like what you just said, if property taxes go from 1.25 to 5% tax, that would push affordability completely out of the out of the reach for most families. So that would be That would be horrible. So
Another scary one, and not many people are talking about it. Interesting enough, reading down here in Southern California, the Orange County Register and the LA Times, this conversation around they're going to increase the state income tax, right? Once you're at the $1 million mark, now you say, hey, how many people are making $1 million a year? Well, be clear, people that are making $1 million a year are currently paying 40% of all the taxes to the state of California.
right.
And most of them live in the Bay Area, right? A lot of CEOs, a lot of executives, a lot of great salespeople. Same thing here in Southern California. And guess what? They're saying we're going to increase it by 1 if their income goes up to as high as 5% additional state income, which means for the wealthiest of income earners. And remember, my friends, this is not political. This is, let's be clear. You sell your house, you pay capital gains, you pay a piece of that to California. In this case, it could be for someone like myself as high as 16.8%.
Yeah.
It's 54% tax. I have a feeling, and they are, by the way, saying it's going to be retroactive. How many companies are going to go public in California? How many people are going to want to sell their business while living in the state of California if that goes through? So these aren't things we can control, but we better be in discussion about them.
Yeah.
If we're sitting on an $800,000 house today that is going to be worth $1.1 million or $1.2 million in the next 2 to 3 years.
Yep.
Someday we're thinking about selling that, or we want to give a piece of that to our children. Things like Prop 13 and the state income tax could have massive negative ramifications on housing in California, and that concerns me.
Yeah, I agree. Well, hopefully everyone will go to the polls and protect Prop 13. That's one super, and we're going to be talking a lot about that between now and November to help, just to educate people, just so that they're aware of what that could do to the state, for sure. Yeah, but thank you so much, Tom. I can't tell you how much I appreciate your help, and I know everyone watching, you are always the kindest to share from your heart everything that you know, and everyone appreciates your knowledge and your experience, and I know that this answers a lot of questions, and of course, keep in mind, everyone out there, we want you to all stay well, stay safe. This has been tough, and our optimism, by any means, I don't mean it to make anyone feel who's lost their job or their business that isn't heartbreaking. We're here to support all of that. We're giving back to our community as much as we can to help people. But overall, things are there's optimism and there's some hope out there. So everybody stay on the hope side, and hopefully we'll all come through this and get everybody back to work.
Now, one thing I will say, thinking about my father-in-law who passed away 2 years ago, World War II Navy vet at 94, he'd be 96 today. He would say to me all the time, hey, it doesn't matter how hard it is, nobody's handing you a gun.
Yeah.
You're not, my Uncle Frank, who's 96, God bless him, right, who got dropped off on D-Day 100 miles away from enemy, past the enemy lines.
Yeah.
When people said we got to stay indoors, I'm like, stay indoors is easy, right? It's easy. So we got to keep things in perspective. We got to stay rational and be mindful just be mindful that headlines in general are designed to get you to react.
Yeah.
Right? Before you react, read a little deeper. Read a little deeper and make sure you know what's going on, because now more than ever, all of us need to be thinking safety first.
Yep.
Take care of ourselves and our loved ones. And we need to keep our life and our businesses and our health and vitality moving forward, right? You can't do getting too wrapped up in all the drama.
Yeah, exactly. And I shared a video earlier today to let everyone know that you were going to be live with me today you did your meds.
Yes.
Take your meds, because that is keeping everyone sane. It's like, you've got to take care of yourself. And like I said, be mindful of, like you said, everything that we do is about keeping everyone safe. Even though we are bullish about real estate, we're still doing it in a very safe way.
100%.
Yeah. Thanks again, Tom. I hope to see you soon in person live, hopefully. Take care and give everybody my best in the family and everything as well.
Right back at you.
Thanks,
Thank you so much. God bless everybody. Take care.
Thank you. See you soon.